Hi. So in this video, we're going to look at the concept of depreciation. Hi. So in this video, we're going to look at the concept of depreciation, which we have already kind of touched upon in the previous couple of videos, and left it at basically a mention of the word depreciation. Now we are going to get deeper into understanding what exactly do we mean by depreciation rates, and how do we account for that, right? So that's basically within the components of a financial statement. So that's part of the first topic itself. Let's understand the concept of a depreciation. Right now, the first question we have in our mind is an asset versus a cost, right? In buying an asset, there is an outflow of money, and in a cost, in taking a cost also, there is an outflow of money, right? So if I buy a pen and if I buy a factory, in both these cases, money goes out from the company to someone else, right? Now, how do I know that the pen that I bought is actually a cost and the factory that I bought is actually an asset, right? How do I differentiate between the two? Because both entail an outflow, right? The key differentiation is from the concept of useful life, right? An asset or a long-term asset is an investment that is expected to generate income in the future, for example, a factory or a truck, and usually over its useful life, right? So it will generate money for us over its useful life. A cost, on the other hand, any expenses incurred on products and services that are used up within the same period, right? Within the same period, if there are some costs that are taken up, that's basically the cost that is going to come in, correct? Now, from that perspective, it is important for us to understand that anything that has the useful life of more than a year is going to get classified as a long-term asset. The moment you classify something as a long-term asset, it is unfair to the company if we take the entire cost of this asset in the first year when it is paid. Let's say we are buying a truck. We are buying a truck worth 10 lakhs. If I treat this and the truck is going to, let's say, get used over the next 10 years, right? It is going to generate revenue for me over the next 10 years. It is unfair if I create a profit and loss statement where in the first year the cost is 10 lakhs and in the next 10 years there is no cost, right? Remember, in finance and in accounting, we work with the principle of matching revenues to the expenses that are created, that are taken in order to create those revenues, right? So we have to basically divide this cost over the useful life of the asset so that the revenue it generates can get matched with the cost that is taken, right? So depreciation is nothing but this division of the cost over the useful life of the asset. So depreciation refers to the gradual consumption of a long-term resource or asset. This gradual consumption is captured by reducing the accounting value of the resource in each period. So if the value of the truck was 10 lakhs here, we will use up probably 1 lakh in 1 year, and then the value will remain at 8 lakhs, then at 7 lakhs, and so on and so forth. In simple words, if you were to sell the truck in year 2, you'll probably make 9 lakhs. If you were to sell it back in year 3, then you're probably going to make 8 lakhs. If you're going to sell it in year 4, you're going to make 7 lakhs, right? The value of the truck keeps declining because year after year, you have used some part of this truck, right? This gradual consumption of the asset will effectively be known as depreciation. So every year, there is some value of the truck that is being lost. That's 1 lakh in year 1, 1 lakh in year 2, 1 lakh in year 3, 1 lakh in year 4. If the truck's cost was 10 lakhs, you are saying that the truck is being used over 10 years. Every year, you're using 1 lakh, right? That's basically the depreciation. That's the definition of depreciation that we see. We will look at the implication of the depreciation in the balance sheet at a later point of time. From the profit and loss accounts perspective, you will not record 10 lakhs in the first year and 0 in the subsequent years. You will record 1 lakh in each of the years over the useful life of the asset. right? That's how you broadly divide it. So let's see how it works. Let's assume that we buy a truck in the year 2010 for 10 lakh rupees. Now we assume that the truck can be useful for the next 10 years. So that's the useful life. And after 10 years, it will have to be replaced. The reason could be wear and tear or obsolescence of the model. And we are saying when it is replacing, then its value is zero at 10 years, right? So it'll lose all its value. So the truck's value is then written off or accounted over the 10 years. Now remember, this is an accounting treatment. So you start with 10 lakh in the year 1, 9, 8, 7, 6, 5, 4, 3, 2, 1. Till the 10th year, you reach a value of 0, which tells you that you have to replace the asset now. Now this asset is no longer useful. You will not be able to generate revenues out of it. So in a way, the depreciation also tells you that the useful life of the asset is over. You're supposed to now go ahead and replace this asset. If you can replace this asset, essentially, you can then go ahead and buy a newer one. The key is what is written here. This, remember, is a pure accounting treatment, and this need not indicate the actual sale of the truck in any year. Remember, if we were to sell a truck, we may end up getting a different value as compared to the value depicted in the financial statements. Correct? We are just doing an accounting treatment saying that it is assumed that the truck will lose 10% of its value, 10% of value every year. That's an assumption that we are making, right? Under that assumption, we are playing it. Now, let's say we try to sell the truck in 2013 and we make 7.5 lakhs on it, then practically the value that we have recorded in the balance sheet is 7 lakh. The value that we are getting is 7.5 lakh. The difference of these two is 50,000. That is essentially the profit we will make on selling the truck. There will actually be a tax implication on this when if we go ahead and get this profit at some point, right? Anyhow, the treatment of this profit is not our headache at this point of time. What we are basically looking at is essentially what is the meaning of depreciation and how does it impact our analysis, right? So remember, depreciation is a notional expense. It's a non-cash entry. How much is the cash expense? In this case, there is a cash outflow of rupees 10 lakh in the first year. That's very clear. Remember, cash outflow is 10 lakh. After that, there is no cash outflow for the rest of the year. But rupees 1 lakh of expense is booked each year. That's an accounting entry that we are putting in. That's an accounting entry we're putting in. This is to show that the truck is losing 10% of its value each year over its useful life. That's the idea, right? So actual outflow of cash took place in year 1, but is accounted for over 10 years. So if you were to just kind of understand, your cash flow will show minus 10 and then 0, 0, 0 each of the years. But your P&L will show minus 1, minus 1, minus 1, minus 1, minus 1 each of the years over the useful life, right? Since this deferring is important, since this asset is not consumed within the financial year, it is consumed over its useful life. So it makes sense that we defer the actual accounting of the cost of the asset over its useful life. That's what is known as depreciation, right? Now, depreciation policies are usually defined under company laws, and it can be something called as straight line or written down value, right? So there is a straight line method or there is a written down method or value that is there. An example will explain the difference of the two. So to understand the example, let's actually go to an Excel file. So let's say we buy the truck for 10 lakh rupees in year 1, right? If I say that the life of the truck is 10 years, then straight line depreciation is going to be 10%, which means if I were to record the depreciation value, that's going to be 10% of 10. And then each of the years, it is going to be the same value, right? So starting from year 1, 2, 3. So if this is where I'm writing the years, is going to be 1, 2, 3, and so on and so forth. For each of the years, the value we are going to write off is 1 each. So at the end of it, the value of the truck is 0. So I can also calculate the remaining value of the truck. That's 10 minus 1, which is 9, and then 9 minus 1, which is 8, and so on and so forth till here, where at the end of the 10th year, the value becomes 0, right? So that's the remaining value that we are talking about. Now, if we were to kind of look at what is the written down value method, in this case, 10% of the remaining value is what is going to happen, right? So I'm again going to copy the same bit, Control C, Control V. Obviously, there are value errors. We'll remove all this. Now, in the first year, the depreciation is going to be 10% of 10, right? What is the remaining value? 10 minus 1. Now, the depreciation in the next year is going to be 10% of the remaining value, not the initial value. In the first case, it was always 10% of the initial value. In this case, it is going to be 10% into the remaining value, right? So that's 0.9, and I'm going to freeze this 10% so that I can drag it ahead. And what is left is 9 minus 0.9. So at the end of the second year, the asset is worth 8.1. Third year, you lose 81,000. Fourth year, 72,000, and so on and so forth. What we will realize in this case is that at the end of the tenure of 10 years, the value has not gone to 0. The value will never become 0 in this case, because whatever value is left, you will remove 10% of that. So when you reach 1 crore, you will remove 10% of that. When you reach 1 lakh, you will remove 10% of that. When you reach 1 rupee, you will remove 10% from that. So you'll never go to 0. So in real life, actually, if you sell the truck at the end of the tenure, even if it is useless, there is going to be some scrap value attached to it, right? That's the premise behind written down method or written down value. You could use any of the two methods. Typically, the companies specify in their annual reports what method is going to be used. That will come at a later stage. But we just need to understand that this, remember, is an accounting treatment. Cash outflow is 10 lakhs, which has happened in year 1. There is no discussion on that. That has obviously happened. What is important is the understanding of the part that the accounting treatment of the expenses could be either on a straight line method or on a written down method value, which will create declining depreciations. There are other methods as well. There's something called as accelerated depreciation, in which case you start with a bigger depreciation value and then obviously the values kind of taper down. So you start with maybe 20% at the beginning and you start with 2 here, and then obviously it kind of tapers down over its life. That's accelerated depreciation as well, right? That's your depreciation over a period of time. There's another term which is called amortization, right? If you remember, we said earnings before interest, tax, depreciation, and amortization. Now, what do we mean by amortization? So far, we were depreciating a truck, which is a tangible asset. Tangible means we can touch it, we can feel it, we can see it, right? There are intangible assets as well. What are examples of intangible assets? Licenses, right? Patents, goodwill. All these are examples of intangible software. These are all examples of intangible assets. Depreciation for intangible assets is termed as amortization. So for example, if a telecom company bids for a license for 10 years and pays rupees 4,000 crore for that, then logically every year from 2015, let's say, to 2025, they've bid. Every year 400 crore is their expected expense out of it, because here it's simple. The telecom license will expire after 10 years. After that, it is worthless any which ways. No one will buy it because there's no value left in it. So the value is 0. So in that case, it will be a straight line decline. And anything that is intangible, if you are writing it off in the form of depreciation, it has a useful life. That's going to be called as amortization, right? So depreciation for intangible assets is amortization. Fine. That's the simple definition. Again, exactly same treatment. It's an accounting treatment. It's a notional expense. It is not a direct cash expense. So that basically explains what depreciation and amortization are. Hopefully that explains us what these two terms in EBITDA are. and what's the relevance of these two terms in EBITDA. As we come to the end of this particular section, define depreciation and amortization. If a factory costs rupees 500 crore and its useful life is 20 years, what would be the cash outflow in the first year? What would be the depreciation in the first year, assuming a straight line method of depreciation? Thank you.